This is an industry that's prone to fashion and groupthink, and we're going through groupthink with regard to AI at the moment. Remember I gave you an example company we invested in and we put in 800,000 and we marked it 28.5 million. If we hadn't been price sensitive on when we first invested, let's say we invested at twice the valuation, then we would have half the number of shares.
Yeah.
And rather than being marked to 28.5 million, it would be marked to 14.25 million. So we think valuations are really important. And yet in the AI space, we're seeing valuations that are tough to justify. Now, for some companies, it makes sense. But ultimately, these are businesses. They're about cost acquisition and lifetime value and margins and what they can deliver. And we're in a period where everyone is very, for want of a better term, furtive. Everyone will play with the latest tool that comes out. And it's really difficult to know where the barriers to entry will really be.
Welcome to the Inside the Fund podcast, where we go on the other side of the table and learn about raising capital from VCs. I'm Helena Fogarty. I'm a fundraising expert who helps startups raise their seed and Series A rounds. And today I'm speaking with John Frankel of FFVC. FF Venture Capital, FFVC, is one of the best performing seed and early stage venture capital firms in New York City. They invest across emerging industries with a strong focus on AI, manufacturing, energy, robotics, and security. FF Venture Capital's team has established a successful track record of identifying and investing in high potential seed stage companies over 17 years and through 6 prior domestic funds. By its adherence to due diligence rigor and a proven set of well-defined investment criteria, the team and the fund are incredibly well positioned to execute an investment strategy designed to deliver strong performance to their investors. FFVC's access to significant and proprietary deal flow enhances its competitive advantage in the space and will further contribute to future performance. FFVC has invested in some of the most successful high-growth companies today, including Secure, Amaze, Rhino, Rescale, StockTwits, Owlet, and Adapar, taking a highly engaged approach, helping their founders build real companies with real business models and leading to higher survivorship. True to their founder-friendly name, their approach, providing deep operational expertise and support, has resulted in a 17-year track record of FFVC portfolio companies graduating to a Series B at a rate 5 times the industry average. FFVC invests in the earliest stage of company formation with initial investments, often as the lead investor with active board participation. I'd love for you to go back and tell me your origin story. Tell us a little bit about your career and what led you to starting FFVC.
Well, thank you for having me on your show. This is really exciting, and what a lovely studio you have here for sure.
Why, thank you.
Beats being on Zoom.
That's the whole intent of having you here in person.
So origin story, gosh, that sounds Marvel.
Yeah.
But
You get to choose if you're the hero or the villain in this one.
yeah, so like most people, I stumbled out of university trying to, sort of work out kind of what I wanted to do, and decided as a de-risking career choice to join a company called Arthur Andersen, which was an accounting firm at the time.
Mm-hmm.
And within 3 years, I qualified as a chartered accountant in the UK. You can tell from my British accent. I grew up there. And spent another year trying to work out what I wanted to do. I did various things at Arthur Andersen, but ultimately I decided it's not the place for me. Looked around and got a job offer from this firm called Goldman Sachs, which in the UK was completely unheard of. And of the 4 offers I had, they were offering the least money and they're the most obscure of the firms. But a friend of mine, Arthur Andersen, who's American, said, no, that's the one you want to go to.
Mm-hmm.
So I joined Goldman Sachs in their controllers department, did about every job in controllers. Then I moved to operations to help give a business perspective to operations. Moved over to the US, set up the offshore administration business, the London global custody business, and then came back to States permanently, re-engineering prime brokerage. So all of these are different businesses that were new businesses being built at Goldman. And I was sort of the liaison between the tech department and the business unit. And I remember, this must have been about 96. And I was talking to the chief technology strategist at Goldman. I said, our solution is to build an application that sits on the desktop of our hedge fund clients so they can reconcile with us and pull data from our mainframes. I go, what if we use this Mosaic browser thing and they could log into us and upload their data and then run the reconciliation on our system, then we don't have to build an application. And guy at the time, Jacob Freeman, great guy, thick Ukrainian accent. And he said, John, this internet, it's a plaything for you. We're talking about real business. So, I tend to feel I had a good sense of where things were going. I moved subsequently, and for the last 11 years at Goldman, to sales and trading floor as equity research salesperson. And 99 was a crazy year. My personal account, despite all of the trading restrictions Goldman had, I was up tenfold. And I looked around. It was the first time I had sort of real investing capital. And I said, I don't want to have it in the public market, so everything's high beta. And I decided to start angel investing. It was all alpha, not beta. There's no daily mark to mark, so I wouldn't be distracting my day job. And I was pretty successful with it, had a couple of good exits. And by the time I left Goldman in 2008, I was kind of really questioning whether I should be spending 1-2% of my time thinking about that part of my balance sheet and take it full time. I took 6 months off to do nothing. And after 5 months, found myself in a lawyer's office drafting up documents, set up a venture capital firm.
Yeah.
And that was 17 or so years ago. We have 6 U.S. funds. We have 2 European funds. We're raising our 7th U.S. and our 3rd European fund. Office in New York, office in Warsaw. And having a lot of fun. It's just fascinating. And the technologies and where we focus have changed over time. There was a lot of social in the early days, and it was seeing a ton of cycles. From mainframe transition to client server, transition to internet, mobile, AI, which we've been investing in over a decade, and then the latest transition, which are these LLM solutions. But I guess that's the origin story.
Yeah. As you're talking, I'm just thinking about this. I'm like, okay, start in 99, you start your fund, you start angel investing in a more intentional way in 99, it sounds like.
Correct.
You've got a crash.
Yes.
In 2000, April something of 2000.
Yes.
You keep going. You then take 6 months off in 2008 and decide to start a fund in another crash. You're like coming out of that.
Yes. I mean, people say, oh, it's difficult raising money now. Try raising money when everyone's rushing to money market and then realizing they're owning a bunch of asset-backed commercial paper and not sure really what that is.
Yeah.
It's the nature of the game.
Yeah. It's just boggles my mind, the timing that you had and the fact that you're here and you're so successful at this point because, it might have been opportunistic to raise money in 2008 if you could raise the money because things were getting revalued.
Right.
Yeah.
Right. And it's the nature of venture investing is the ultimate long-term hold. It is difficult to find liquidity. Sometimes you find secondary buyers. It's always a discount. And so, you have to understand for this asset class, liquidity is illiquidity rather is an advantage, not disadvantage. It's a feature, it's not a bug.
Yeah.
It only enables you to exit in good markets, but in good markets, the premiums are very high. And so, through that, there are definitely alternatives. In 2008, if I'd loaded up on Amazon, done nothing else, it would have been fine.
Yeah.
Or loaded up on Apple and done nothing else. And so there definitely have been public market technology opportunities because, this long technology boom we're in continues to extend. I would have told in 2008 I could see 20 years. Now, there's at least another 20 years of this. And, every company that isn't a technology company needs to be one.
Yeah.
Or will be competed away by one.
Yeah.
And, now you can use AI as the front of that technology layer.
So when you say it's a feature, not a feature, not a bug,
Yeah.
the illiquidity it's that you're in, and then you've got to really contribute to the companies in terms of how you are as an investor? Or what do you mean by that?
One doesn't have to. We do. We've taken a strategy of being highly engaged. Now, every VC says they're highly engaged.
Right.
But as you mentioned, we have 5 times survivorship to Series B. And that means that we've had over 11% of our portfolio get to 100 million revenue run rate. So we think by being engaged, we end up with better outcomes. Now, just because the company is generating 100 million in revenue doesn't necessarily mean that you're going to have a great outcome. They can still mess things up. There's a million decisions from the day you invest to the day you exit. And it's easy for the management team to screw things up at the end or along the way.
Yeah.
If it's early enough, we step in and help. When it's later in the game, that's not what you do as a seed stage investor. You're relying on late stage investors. But we have some pretty good companies under our belt, and we're kind of excited to see how they play forward over the next couple of years.
With so many companies, so many investments, how do you stay actively involved, I should say?
So the first thing is we decided many years ago to build a system of record, a sort of front office operating system. We called it Totem. And the idea was, I got frustrated. I go into meetings and someone would say, how many companies do you have? And someone would go 63 and someone would go 59 and neither of them would be right. And so it just frustrated me that we didn't have, a core set of records everyone agreed. So you start with an address book that has everybody's contact information in. And then you add in layers and layers. So we add in all the cap tables. We add in all the financial data. We add in every meeting. We add in meeting notes now. And so you have this really core stream of record that is institutional truth about the company. So we built this, we spun it out a few years ago. There's now 50, 60 VC firms on it. I don't know how many billions of dollars of AUM run on it. Probably a good vanity metric to know. And each year it just gets better. It's on the cusp now of being able to write the quarterly letters.
Wow.
Because it has all the numbers,
Yeah.
and because of LLMs, note takers and it has all of the words. And so it can do a first draft of a quarterly letter, which I think is fascinating. I want to see how good that is.
Yeah.
It's probably as good as
First draft.
as an intern or an associate would pull together. And, it saves you probably 60, 70% of the time of putting them together.
Yeah. And especially if there's procrastination to get started, that can take the first, draft off the plate.
Right. So,
Yeah.
So we find that adds a lot of efficiency, and keeps everyone, on the same page, literally. But you do it just by working hard and talking to people.
Hmm. And how often do you, how often would you say that the board members talk to their startups?
Well, it varies. Most of our board meetings are monthly.
Hmm.
As companies get more mature, they move to quarterly. I sit on an ungodly number of concurrent boards at the moment, and I think my attendance record is 98, probably 99%. I really try and attend board meetings, whether it's a board member or board observer. But as a board member, I think one of my colleagues collated this. I've sat on the boards of over 60 companies over my career, which is a large number. Uh, so there's definitely the pattern matching of sitting in the board and, kind of observation and the like. But it also, it helps you give advice to the founders on how they need to think about all of the issues that will percolate up to the board, particularly as they get to be later stage and the boards become much more formal and challenging sometimes for founders.
I just want to circle back to Totem.
Yes.
Totem is now a product that you offer to
Well,
other funds.
we spun it out,
Okay,
so it's
spin it out,
independent. We're a shareholder,
Yeah.
but it's independent of us. It's at totemvc.com if anyone wants to check it out,
Yeah.
and it's really picking up a lot of traction right now. Growth is accelerating. We've built a couple of companies over the years. Totem being one. Another one was Graphite Financial, it's an accounting firm.
Yeah.
For startups. As I mentioned in my origin story, I happen to be a chartered accountant, so I have a certain respect for numbers. And what we found was most founders think in terms of GAAP because their accounting firms give them GAAP, and that is useless for managing cash flow.
Yes.
So you kind of want a cash P&L. And then if you have more than one product, you probably want a product line contribution margin cash P&L. And most firms could do it, but they just don't.
Yeah.
And the founders don't know to ask. And so we think probably 10% of companies that fail, at least 10% of companies fail because there's no good accounting. And when, it depends on the models, but where you have marketplaces, where you have companies with negative working capital, there are real peculiarities to them. For example, you have negative working capital and you're growing at 70% year over year and growth slows to 50%. You're suddenly going to run out of cash if you're not careful.
Yep.
And most founders don't realize that. And most VCs that don't have an exposure to how to understand balance sheets and P&Ls also have a problem.
Yeah, and I would imagine there's also timing to that. Like if you need to have real-time data if your growth is slowing, if you're in a...
Well, I mean, it depends on the business.
Yeah.
But, most founders will see accounting as something they have to report someone ex post, and it can actually be a proactive tool, for sure.
Yeah, and I find a lot of early stage founders don't know what they need to have the foresight.
And that's what we try to bring to the table. So, we are not... I mean, we've got one of our new companies is doing high-speed jet engine drones, like 2 foot by 2 foot. So very small. They're meshed together. They go on missions, and it's really interesting piece of technology. I will say I know nothing about the tech, but I know a lot about all of the business precepts necessary to make this actually a business and not a science experiment. So we have, in the drone space, high altitude drones. We have Mana out of Europe. That's his last mile drone delivery. They've had well over, I think, 20,000 in production deliveries. And our focus with the Mana team was always around business model and what are the key metrics, not around, prop design
Right.
and vibration suppression
Right.
and that kind of stuff.
Yeah. So we talked a lot about your origin, how you started your first fund, but how did you raise money for your first fund?
So I'd been fairly successful
Mm-hmm.
and I had a pretty large Rolodex. So I went to friends and family and said, I'm planning on doing this. I've done it with my money. Would you like me to do it with your money?
Yeah.
And I think for a lot of people, the first funds is friends and family. The second fund was friends of friends and friends of family. And then you sort of take it from there.
Yeah. And how soon did you do the second fund? Was it 3-4 years later?
It was 2 years later.
2
We
years.
did a fund. The first 5 funds were all every 2 years.
Yeah. And now that's changed?
Yes, it's spaced out a little bit more now.
Okay. Why?
I think it's just the nature of fundraising. It
Mhm.
requires a little bit more time between funds to do that.
Okay. I have all these questions right here, and you've already answered.
Sorry?
I have all these questions here,
Oh.
and you've already answered so many of them. Let's see. I think, your background and your career leading up to this, and then the 9 years you had prior, so you had this track record, helped you raise funds, as you mentioned. Do you have any advice for other people who are thinking about starting a fund?
I think whether you're starting a fund or you're starting a startup,
Mm-hmm.
just do it. There is tremendous complexity around both of these,
Mm-hmm.
and it is very easy to get stuck in analysis.
Mm-hmm.
Now, there is one thing, and this is the one key criteria when people come to me and say they're thinking starting a fund, which is this is a 20-year commitment.
Yeah.
Because if you're raising one fund, you're going to raise 2, you're going to raise 3, and the funds are long life. And do you want to, for the next 20 years, do this?
Mm-hmm.
And that's something you have to think if you have a temperament for, and it's the right stage of your life. I think there's a stat out there that over half, or maybe over 2/3 of general partners of funds have never seen carry. And you're not going to get rich off
Ouch.
of management fees
Yeah.
unless you're running, a massive fund.
Mhm.
So it's kind of a really long-term game. And you have to believe that you're going to be, the outlier in the top 10% of people to produce funds that return 3 times commitment.
Mhm.
And the numbers can get big. And, we're also fortunate that this is a space where qualifying small business stock exemption applies. And so you have, a low tax burden on income
Mhm.
that comes from gains, but you have to have them in the first place. And when you're a small fund getting started, you start at the seed stage. And
Yeah.
seed stage can take a long time to exit. But they can exit very well. Yeah, and it's weird because none of the metrics actually work for early stage.
Mhm.
So every metric that you try to measure performance on is trying to estimate what cash on cash returns will be.
Mhm.
And that breaks down. IRR doesn't work. DPI doesn't work because literally once you distribute it, it's no longer part of your future return profile.
Mhm.
And it takes a long time to get to liquidity.
Yeah.
But look, I'll give you an example. We invested in a company, 12 years ago. We put in 800,000. As of Q3, we marked it to 25 million. As of Q4, we marked it to 28.5 million. We think in 3 years it could exit at reasonably, I mean, it's this, there's like this curve, this sort of like growing curve of outcomes. But if you take the central case, it could exit at 100 to 120 million in a 40 million fund for an $800,000 investment.
Yeah.
How does IRR capture in the last year that you hold it? You're going to add 30, 40 million, which is like 1 times the fund.
Yeah.
So you don't capture that in current IRR. You don't try and smooth a curve, because if you smooth a curve, you're overvaluing it today. And by the way, tomorrow they could trip over their shoelace and be worth 0.
Yeah.
So, but the nature of this game is it's for the outliers. So you have 30 companies in your portfolio. It's going to be 3 that will determine the returns. And those 3 will depend on where the market is, when they exit, what multiple they get. And for high growth companies in a good market, they can get, I mean, 21, we were talking about 30, 40 times revenues.
Yeah.
Yeah. I'm wondering in a good market if you can get 10 to 20. So I'm being, conservative versus 21. And we may never's a long time, may not for a long time see those kinds of multiples, but you never know. I think we're definitely back into an upswing. I think animal spirits are being released, regulations are coming down, ton of cash on the sidelines, which will come into assets as interest rates come down, which I believe they will. Tariff income and growth, if we get both of those playing through, we'll be able to start not growing the debt and maybe paying a little down. You put that together, the debt markets will bring down interest rates. The Fed will start bringing down interest rate at the short end of the curve. And that will mean assets will go up a lot from here. And these are assets. And, it'll play through because, it's kind of interesting. Our larger companies last year were all, how do we get to profitability? This year is, where do we sit on the rule of 40?
Yeah.
And some of our best companies are accelerating. They still came into, one company in particular, I'm thinking of, came into the year saying they'll grow maybe 42%. And now they're thinking they'll grow 55%. It's on a hefty base.
Yeah.
So I kind of look at that and go, aren't that many companies in the public markets growing more than 25%? So who knows where these things will be valued? And wherever they exit will be what determines the returns of the fund, because they become very large related. But it takes time.
Yeah.
It takes time to compound.
Yeah. I was just thinking about, there was a study released by Carta of, the spray and pray approach for VCs versus being deeply involved in the portfolio. And it sounds like you've got a better picker and you're deeply involved.
So it's difficult for me to believe that the spray and pray approach doesn't, and particularly with a large number of positions, doesn't approach median returns.
Right.
And though I think median returns in venture are decent for sure, you would want to believe, because this is the ultimate buy and hold strategy, return dispersion in the space are very dramatic. Like, the worst quarter, the bottom quartile loses money. The top quartile makes a lot of money. The top decile returns 3 times, 4 times plus. And then there's always the outlier fund that returns more than that. And we have one of those that's on track to be 6 to 10 times. We've returned about 3 times already. But if you can return 3 times commitment, you're in the top 10% and you're doing great. So we kind of want to skew into top quartile, top decile. And it's very difficult to do that with an approach where you're not engaged and you're just trying to index the space. Now, again, the index of the space is not necessarily bad versus other sectors, particularly because it's uncorrelated. It's a basket of alpha, and basket of alpha in a portfolio construction perspective, are very valuable because of their lack of correlation.
Mm-hmm. Okay. So I had heard in the past that you were focused sometimes. Sorry, I was about to speak Spanish to you. Uh, sorry about that. I speak Spanish at home, so that sometimes comes out. I had heard in the past that you had talked about, this idea of doubles and triples, but it also seems that you do have moonshots in your portfolio and you are driving.
No, we're not about doubles and triples.
Right. Okay.
We're about moonshots.
Mm-hmm.
We really like to think about companies that exit 30, 40, 50 plus times our money.
Yeah.
We have one that's exited recently where we made, I think it was 32 times. Not on the first investment, that was obviously more, but on average, because we made more than one investment in this company. But what's interesting is 32 times for our LPs is tax-free at a federal level, and depending on the state they're in, because it qualifies for qualifying small business stock exemption.
Yeah.
So for those that are taxpayers, 32 times is like something like, I hope I get this right, about 44, 45 times
Mm-hmm.
for if you're paying long-term capital gains tax.
Yeah.
And would need to be over 50 times if it was a hedge fund type return,
Yeah.
a fully taxable short-term gain. So, and this is the weird thing that people don't get about this. Imagine a portfolio of early stage, assume everything is QSB,
Mm-hmm.
assume 90% of your capital is written off and 10% of your capital works. And that
Right.
10% of capital returns the whole fund. So basically you put in $1 and you get $1 out.
Mm-hmm.
But 90 cents of that dollar are losses that you can use against the rest of your portfolio.
Mm-hmm.
So this is a strange strategy where your post-tax returns are higher than your pre-tax returns. And God forbid, 30% of the portfolio works.
Yeah.
So you get 70% write-off, which you can use against short-term gains and other stuff.
Yep.
It really juices the after-tax returns of this space. It is actually a very attractive space, and it's not well measured.
Mm-hmm.
As I said before, the metrics don't
Yeah.
really capture it.
When it
appropriately.
works.
When it works.
So let's talk about the write-offs. What happens when you invest in a company and it's not doing well?
So so let's start back one level. We like to invest in what we call businesses.
Mm-hmm.
So something like a Facebook would have been difficult for us because it wasn't a business until it got to its third or fourth round.
Yeah.
So we like things that can monetize early
Mm-hmm.
so that you can start to really refine the business model and the like. So let's start there. We're now, we've done the seed round, or what today people call pre-seed round, and you get a year in, companies running a little short of money, etc. Well, you backed it because of a team,
Mm-hmm.
because of space, because of the business model. Do you still believe in the team, the space, and the business model? Do they just need a little more runway to prove this out? That next check is usually quite easy.
Mm-hmm.
The check after that, things really need to start working for us. We need to start seeing some momentum and the like. We will be patient. And there are definitely situations where we've been patient. We've definitely had companies that stumbled over their shoelaces, that couldn't make payroll or something happened and the like. But if you still believe in the team and the space and the business model, then we're more likely not to back them.
Mm-hmm.
Now, this is a different approach, I think, than other VCs. I think most VCs look at their portfolio and they go, a third's going to go to zero, and a third's not going to work, and a third will work, and a third of a third will really work. So, and everyone's busy. So their model has been, if they get a call, the company's in trouble, it's in the third doesn't work.
Yeah.
It's in 2/3 I really don't care about. I only care about the ones that are really working. And so they'll tend to give dial tone. And we've just had an approach, and we thought it would take a decade. I think it took about 15 years to prove it out, because there's definitely times we've stepped up and put more capital and more time and energy into, and the thing just face planted and didn't work out. But I think on a return on invested capital approach, stepping up has worked. Even in the, I will tell you this, we've been in this business, as I said, for 17 years, and as in angel investing for 9 years prior to that. I still haven't formed a hard opinion as to whether pay to plays work. As
Interesting.
on an
Yeah.
average basis, is it worth stepping up or not? And there's some funds out there I respect a lot who just never participate in pay to plays. Like, okay, that's in the 2/3. But we've had a couple of pay to plays in companies that just bridged them to the next level, and then they became a very dominant company in our portfolio, and we're like, okay.
Yeah.
So, you've got to average all this out, and is the data set big enough to be able to really form an opinion? But I'm not yet sure on pay to plays. But where companies struggle, and we still believe in those 3 key criteria, our bias wants to step up.
Yeah. So I just want to dive a little bit into that. If those 3 things have changed, is there an interest in having them shut down so you can write it off? Or is there kind of just, you do your thing? Like, what is that
Well,
dynamic?
we never have a control position. We're often on the board. And it's like, if the founder doesn't believe the story's run out, being the person to tell them to return capital,
Yeah.
it doesn't tend to work. So it really depends on the founder and how they look at the space. But we've seen founders like run out the clock, and it's been frustrating. Not that often. It's probably about 1% of cases.
Yeah. I think as a former founder, it's hard to know when to call it.
Right.
Yeah.
And we've definitely had other situations where we've like, let's play it on,
Yeah.
but it very much depends on the dynamics.
Yeah. So I think having a trusted advisor or even board member saying, listen, it's time, it would be almost a relief in some cases for some founders.
You would believe so, but it depends on the founder.
Yeah, absolutely. Can you tell us a little bit more about like what kind of founder or what kind of founding team gets you excited?
So the ones we tend to really engage with is when in that first meeting, there is a meeting of the minds on the vision. And as they're describing the vision, we're like, I don't want to say completing each other's sentences, but there's a little bit of that. There's a little bit of, we totally get it. And often with the founders, they are surprised how fast we come up to speed on what they're doing and how we articulate where the business can go. So I think there's that sort of real meeting of the minds around what the business is trying to do and where it can go and what it can do. And then where you think you can be helpful. When, we have a belief that we don't just want to be financial capital, we want to be intellectual capital. And we found the ones which are most successful, we're able to lean in and help them, particularly in those early stages, getting up to the Series B level.
Is there any secret to evaluating the founder? Is there any secret sauce there? I know, we spoke about, sorry to
Mm.
triple my questions, but we spoke on the phone before this and we talked about cold outreach versus warm intros.
Yeah, I would say almost all of our investments have ended up being warm intros,
Mm-hmm.
not intentionally. We still run a process with it, with everything that comes in to see if it fits or doesn't fit or the like. But on an ROI basis, we would probably recover a lot of time if we ignored every cold intro
Mm-hmm.
because they tend just to not get into the portfolio. And it's not a matter of a priori bias.
Mm-hmm.
It's just a matter that, for whatever reason, yeah, cold intros tend, and so I will put it this way. I think every VC has said warm intros work. So if you are a founder and you can't work out
Mm-hmm.
how to get a warm intro to the people you want to talk to, you've kind of like failed the first test. I think that's probably the right way to think about it
Yeah.
because it is it's a low return strategy. It's not just for us. I'm sure everyone else feels the same. Some people just block it out. I was talking to one VC and he's like, I only invest in founders who have exited a company above a certain valuation. He goes, that's my criteria.
Mm-hmm.
And I'm like, okay. He goes, because I go, yeah, but you might miss something that, first I goes, yeah, I know.
Yeah.
So I think every VC has their own criteria,
Mm-hmm.
but I think a lot of them coalesce around warm intros lead to a higher chance of it being a company worth investing in,
Yeah.
which leads to a higher chance of being investing, as opposed to it's an old boys club. And yeah, because I don't subscribe to that approach to investing.
Yeah. And I think that there's this balance, and VCs are very data driven
No.
and they want to make things efficient.
Yeah.
So they're creating these frameworks that work for them.
Well,
But
that's right. But
yeah,
also look at it the other way.
yeah.
Most companies fail. So from a founder's perspective, their chance of success is low.
Yeah.
If you have 100 pre-seed companies that get funded, sorry, on average, 30 raise a Series A, 10 raise a Series B, 1 goes public, and probably about 1 gets to 100 million revenue run rate.
Mm-hmm.
A very high failure rate.
Incredibly high failure rate. But when you're a founder, you're
Yeah.
like, it's not going to be me.
I'm
I'm going to be the outlier.
which is absolutely true. But to be the outlier, do the work and network in to find the right source of funding. And by the way, the most important thing you can do, if you do find someone who wants to fund you,
Yeah.
is reference them.
Mm-hmm.
There is a bell curve distribution of people who you will want to work with. Just make sure you're the right side of the bell curve.
100%.
There are a lot of people in this business who are less fun to work with.
Yes.
I'll put it that way.
Yeah. And I think that every person has those people that they like, they don't like. And you also, in addition to referencing them, you have to just have a feel.
Well, I mean,
Yeah.
I use fun, but it's more than saying they're fun to work with. The people who I know a number of founders who say, I will never take money again from
Yes.
Joe or Mary or whoever. And it wasn't because of fun. It was because, they got themselves into a relationship they didn't want to be in.
How do you feel? I recently saw an example of a company that's about to they're between term sheet, due diligence, and the wiring date. When they signed their term sheet, the company that they chose, the fund that they chose to work with, said, "We're not giving you references until you sign the term sheet." How do you feel about that?
It's fine.
So they're shutting down all their options
Well, I mean, yes.
without referencing.
Well, let's be clear.
Yeah.
The chances that they have no connection to the 50, the 100, or whatever companies
Mm-hmm.
that VC has invested in before
Yeah.
is very low.
Mm-hmm.
If they don't know someone, they have to know someone who knows someone. Just network and do the referencing behind the scenes.
Yeah.
Yeah, I will tell you,
Yeah.
we don't even give a term sheet to someone until they've referenced us.
Mm-hmm.
And we say, we give them as many as they want, but usually it's 3 or 4, and we just do a connection email.
Yeah.
Hey, Joe, meet Mary.
Yep.
And we don't even set context. and it's kind of like you should reference the people you're going to take money from.
Yeah. I mean, I told the founder, I was like, here are 5 names you should call, like you should get in touch with them right now.
Yeah.
But he didn't know if that was going to get back to the fund and,
Well, to be
cost
clear,
bad blood there.
to be clear, if it does, then that's probably not someone you want to take money from. You have to understand that your funding relationship with a VC
Mhm.
is longer on average than the average marriage.
Yes.
And the divorce is more difficult.
That's rough. With kids or without kids. What is the biggest lesson you would say you've learned the hard way?
Biggest lesson I've learned the hard way. As a general rule, well, I'll give you 2. One is, if you're an early stage fund, don't do late stage rounds. You can't put in a check that's big enough
Yeah.
to move a fund and not fail. And it's got to be big to move a fund, but then it's too big on a risk adjusted basis. So following into late rounds for an early stage fund doesn't make sense. So we stop investing at a 50 million valuation. We try to capture that early stage alpha. We have invested in a couple of companies where the founders are ex-CIA, and we've made a rule, soft rule internally: don't invest in founders who are the CIA.
I want to dive into that, but I don't know if you can tell me.
Well, no, it's like they're just trained to lie too well, and so you never quite know if you're getting the true story or not.
Yeah. They're too smooth. That's amazing. How should people who are raising right now think about valuation?
You want to think about the amount of dilution you take at each round, for sure, but don't get hung up on a round. You should actually, honestly, watch the whole season of Silicon Valley twice. By season 3 or 4, it just becomes a handbook. There's this great scene where this guy goes, "I could have taken less money." But seriously, you want to raise the amount of money you want to raise, and you need to find the funds that are the right funds for that. But sometimes you can be forced to raise too much money, and then almost every founder spends money they raise. They raise more, they spend more, they scale prematurely, they have to then fire a bunch of people, capital gets wasted. It's kind of really tough. So, I think it's important to understand each round is a battle, and you're trying to win the war. Don't try and optimize each round. If you raise too much money at too high a valuation too early, you'll never grow into that valuation. And that will be a problem. So you were great believers in staying really lean until you're at the right point to scale.
Yeah.
Now, for some businesses, not the kinds we would fund, for some businesses, capital can be used as a weapon. So, it's a little idiosyncratic, but I think when markets are frothy, it's tempting to raise more money early. And, one thing we shy away from what are called party rounds, where no one really takes the lead.
Yeah.
Those have no sponsorship to the next round. Everyone's just buying an option, which means the company, the CEO, is writing options. You don't want to be the person writing options.
Yeah. Yeah, you need someone to bring you.
Well, you need the advice.
Yeah.
Right? Again, the bare stats are not great.
I think you just mentioned some of this, but what are the mistakes you see founders making repeatedly?
Number one is not numbering the slide deck.
But then it's difficult
Seriously.
when you've got to reshuffle things. Tell me more.
That's auto numbering. It's all about execution. So don't get too hung up about the idea. Talk about the idea to people. We've generally found no one has been penalized over the years for being very open about what they're doing. It is about the execution for sure. Sometimes they, as I mentioned, they optimize for the round and not optimize for the exit and where they're really trying to get to. And honestly, look, there's a group of people when they take other people's money that feels a real responsibility. And if you're like that, great. But if you're not, be careful, because you can just ruin your reputation over time. Ultimately, people are trusting you with capital. For VC, ultimately, your LPs are trusting you with capital. And you have a fiduciary responsibility to end up with the best outcome for them.
Yeah, I felt a tremendous amount of responsibility. Like first it was like, yay. And then it was like, oh, wow.
Yeah, but some CEOs don't behave like that.
Yeah, of course.
Small group.
Yeah. Let me see what else we have on our list today. Oh, this is a fun one. This is the one we spoke about on the phone that I think, was a little bit of attention. But, is diversity or removing bias part of your investment is a focus for FFVC?
So, unfortunately, we look at things from first principles. And so we don't just buy into ideologies. And we think there's a lot of people who do in this whole space. We think diversity is important. We think inclusion is important. We think equity is a Trojan horse because it leads to quotas and it leads to bad outcomes. We think equality is fine, but equality is not equity. In our understanding, equity is about equal outcomes, whereas equality is about equal opportunities.
Yeah.
And so it's a really difficult space because you get asked, well, how many of your founders are women and how many are gay and how many are transsexual? And I'm like, you want me to objectify all my founders? Well, no, you shouldn't objectify people. I go, okay. So you want me to ask everyone, excuse me, are you transsexual? You walk a little funny. And it's like, you can't do that either. So we really have a problem with the whole methodology here. And we think there's a lot of people in the space who don't think about this from first principles and take offense. What I will tell you is we probably over-index, but we don't measure it because to measure it, we think is inappropriate. I don't want to ask someone about their sexual preferences ahead of a conversation about whether we're going to cut them a check or not. That seems weird. Or if we're going to help them or not. It really shouldn't be part of our conversation, which is to treat people by the character, by their character and how they, how they act as founders. I will tell you, we listen more intently when there are founders from minorities, from women who are actually a majority in the population, but whatever. We listen a little more intently. And I think we over-index on where we've invested. But, we really, try to be, blind to all of this, because we think not being blind to it is not something you can actually do without it being offensive. And we're concerned that you just end up with outcomes which are suboptimal for everyone involved. So, we want everyone to succeed. And as I say, we'll give a little extra time to listen to, a little extra hearing to folks from obvious minorities with regard to what they're trying to do, and see if the business itself makes sense to back and the like.
So I'm jumping from a very serious topic to asking you about your hot takes on
Okay.
the industry. Do you have any controversial opinions about how things are going right now, or even reactions to founders finding ways to reach out to you without respecting boundaries? Anything that's happening in your world right now that is not right.
So this is an industry that's prone to fashion and groupthink. And we're going through groupthink with regard to AI at the moment. Remember I gave you an example company we invested in, and we put in 800,000 and we marked it 28.5 million as of Q4 last year. If we hadn't been price sensitive on when we first invested, let's say we invested at twice the valuation, then we would have half the number of shares.
Yeah.
And rather than being marked to 28.5 million, it would be marked to 14.25 million. So we think valuations are really important. And yet, in the AI space, we're seeing valuations that are tough to justify. Now, for some companies, it makes sense. But ultimately, these are businesses. They're about cost acquisition and lifetime value and margins and what they can deliver. And we're in a period where everyone is very, for want of a better term, furtive. Everyone will play with the latest tool that comes out. And it's really difficult to know where the barriers to entry will really be. Remember I mentioned Totem, and we have a note taker that sits in our Zoom meetings. And Totem happens to use one of the known providers out there.
Yeah.
And they use one of the models out there. Now, that provider may switch models. I don't really care, right? Totem may switch provider. I don't really care.
Yeah.
I can assume both will optimize so that over time, I'm going to end up with better transcripts. It feels to me like a commoditized layer.
Yeah.
Yet one of these companies just raised money at $1 billion valuation. Now they're probably ramping up with a considerable amount of revenue, but to what extent does this become commoditized, and when does it become commoditized? Yeah, I think a company like DocuSign, I find amazing. They charge thousands of dollars a year to corporates to do what they do, and Google recently offered the product for free. That's part of the Google suite, but if you already have Gmail, you're paying for it. So, have they got a strong enough brand that a free offering from Google is enough to undermine them or not? I don't know. And so I look at this, and it's very difficult to know where the commoditized layers are and where non-commoditized layers are.
Right.
So I think there's a lot of sloppy thinking in the space. I think there's a lot of valuation work that really needs to be considered. Now, against that, AI is driving massive valuation boosts to some of the largest companies in the world, and it may well be justified for those companies in what they're doing and how they're doing it. But then again, you've had Elon Musk come out of nowhere in 2 years, build some of the most powerful models. Versus OpenAI that's been around for I don't know how many years, or what Google's doing. So we're in the early stages, and it's tough to know exactly where it all lands.
Yeah.
What I tell you is these tools are useful, and I think they will be part of the framework going forward. We just have to work out what's commoditized and what isn't, and it's not clear.
There's so much that's not clear in the effects of what we're doing right now, which is, I mean, it's exciting.
Yeah.
It's amazing. Yeah. I want to ask you how you stay healthy, mentally, physically, emotionally, doing what you do.
So, as well as working at Goldman and the like, I also have a bunch of kids.
What's a bunch?
6.
All right.
And so I'm blessed with a bunch of grandkids.
Yeah.
We're expecting later this month, number 15,
It's really exciting.
God willing.
Yeah.
And so I think that really keeps me grounded. And it's funny, when I was in my early 20s, I said, if I want to be respectful to my mid-60s self, I want to have, if I'm going to have a bunch of children, I want to have them early, because I don't want to be, 65, retiring, kids leaving home. That's like a triple whammy.
Yeah.
And so our kids left home a decade ago. I'm in my mid-60s now. And so now I'm in my mid-60s. I'm like, how do I be respectful to my 85-year-old self?
Yeah.
So I think being able to get out of a chair unaided or get out of the back of a taxi is a pretty good thing. And so, there's a lot of data here, and there's a lot of thought around it. But I try to get to the gym 3 to 4 times a week. With an expectation in my 70s, I'll probably have to go 4 to 5 times a week. So I think as you get older, you have to do more resistance training. Walking is really good. Sunshine, I think, is very healthy. So it's a combination of those dynamics at the same time as family and social, at the same time as work, which keeps you intellectually engaged. So it's a combination of those. But I had this, I'll call it insight, but that probably makes it sound too grand. I had this perspective in my 20s that every year you got older, you had to do more exercise to keep your metabolism stable.
Yeah.
And so I decided to do no exercise till 40 and then slowly step it up. And I've actually lived that. And, I'm now, I go in the gym for an hour and a half, 2-hour sessions. And I'm one of the very few people who do that this kind of length of resistance training to failure of my age. And, I think you lose, I saw a stat, I don't believe you lose half your muscle mass between 60 and 70, but you probably lose about a third.
Yeah.
And I want to have more muscle mass when I'm 70
Yeah.
than when I'm 60. I think it's really essential, and the muscles keep the bones strong so you don't get osteoporosis, and there's more and more indications that it helps just across body and the like. So I'm a great believer in paying attention to that, because I think health is important, and it comes down to health span as well as lifespan. There's a whole lot of work around here, and the important thing is working out whether you should be doing, which I'm not doing any of this, hyperbaric or not hyperbaric, whether you should be doing hydrogen water or not hydrogen water, cold plunge or not cold plunge, sauna or not sauna, red light treatment. There's a whole series of stories and buzzwords and approaches people are taking. And at some point, I think you got to pick the things you want to do and then chill. Because I think you just drive yourself insane if you're not careful and not enjoy life and the moment and everything that comes from that. But I will tell you this: it's a lot of energy having a bunch of kids, but it's like the grandkids are just amazing.
I mean, there's a couple things I'm struck with. Like the grandkids thing is amazing because I think when I'm in it, I have a 14-year-old. I can't
Which is a
always,
great age, buddy.
yeah, but I can't always enjoy it, right? Like I'm not, because sometimes I'm just in it.
Teenage years are not designed for parents to enjoy.
Yeah, but I think at this point, I can look back at when the little kids, and I actually think they're cute at this point. So, when I become a grandparent, if I'm ever lucky enough to get there, I think you can enjoy it because it's finite and bite-sized pieces. It's pretty amazing. But another thing that I was struck by in our conversation over and over again is this idea of a 20-year horizon, thinking forward,
Yes,
planning ahead.
So let me give you a dumb example. And I talk to people in their 20s, and I say your 20s and 30s are periods to compound your skill set, your Rolodex, right? And they nod along. Money,
Yeah.
and family. And they go, huh? I go, let me explain family. I go, most people, the meme in society is just to drift. Come sexually active, you date, you play the field, you eventually find someone, you then live together, you eventually get engaged, have a long engagement, you get married, let's have some time before we have kids. And then when you try to have kids, you're infertile. But what happens, and particularly for women, is you get into your 30s, fertility falls off a cliff. And I go, if that's what you want to do, fine. But make a decision, because the earlier you have kids, it's like the first 20 years are tough.
Yeah.
And if you're going to live 80, 100 years, where do you want that tough 20 years to be? The earlier, the better when you have more energy. And by the way, you can then be like me, mid-60s, and I've got 10-year-old grandkids.
Amazing.
And, their mother wants them to get married when they're 18. But, it's conceivable in my 70s, I could meet some great-grandkids.
Yeah.
And if I get to my 90s, that's a wonderful thing.
Yeah.
Now, I have full respect for people who say, I don't want to have children and the like. But I have to wonder, as they get to my kind of age. I mean, you talk, it's funny, my grandfather used to say when he was in his 60s, anyone my age, if you ask them, and now I have to say, anyone my age, if you ask them, they tend to say, I wish I had more kids. They never say, I wish I had less kids. And so, are kids expect? Yeah. Poor people have a lot of kids. They somehow manage to make it work. You're smart. You're capable. You'll work. You'll find a way to make it work. But the dividends that come downstream are massive.
Yeah.
And so just think about what you want your life to be in your 60s, when you're in your 20s or in your 30s. And, I'm a great believer in voting early and voting often with regard to kids.
I think that there's this idea of optionality and preserving optionality that is ignoring the benefits of long-term engagement. And that goes for your portfolio, that goes for marriage, that goes for commitment in whatever form it is. And there are huge benefits to commitment once you get to a certain point.
It's part of the life journey. I mean, the maturity of someone who is 30 and has a couple of kids versus someone who's 30 and has no kids. It's very different. And God forbid, 40. It's part of the life journey.
Yeah.
And to deny that to yourself which is fine, but do it eyes wide open. Make an actual decision. Don't drift.
Yeah.
And don't, it's like starting a startup. Just go and start it, right? So, yeah, that's one of my sort of hobby horse things that people don't really think about. And I think in life, a lot of people have a 2-year and a 5-year plan. You should have that multi-decade plan. To be quite honest, 65, I wish I had a 40-year plan.
Maybe you have to start
Maybe.
cold plunge.
I mean, there's a lot of advances around longevity, and again, brings me back to hyperbaric, which, was meant to lengthen your telomeres and the blah, blah, blah. But I think there will actually be a lot of research in the next 10 years that could be life extending. But, and at the moment, it's a 20-year plan. And I think it would pay into a 40-year plan, which is be strong and capable. And the human body is capable of doing so much. If you can't do the splits and you want to do the splits, you can probably learn in 30 to 60 days. It just takes a little bit of dedication. You want to do pull-ups, you've never done pull-ups, probably do it. Might take a little longer. Might take you, 6-9 months. Could take longer. It depends. But anything is achievable. The human body is amazing in this regard. And you can work out where you want to spend your time and energy. And against that, particularly for men, resistance training is very important. I think it's the same for women. I just,
it is.
being a man, I focus on the male
paying
stats
attention to.
because they're differential.
It's very important. It's actually a health span key for women.
Yeah.
It's
So
lifting heavy.
it would make sense. It would make
Really
sense for it to be absolutely.
Yeah. Well, I think we've covered it, unless there's anything you feel.
No, I mean, listen, I want to thank you once again for having me on this show. I'm very excited about the technology stack in front of us. I'm on X. If anyone wants to follow me, my handle is John_Frankel, first name, last name. But I think these are incredibly exciting times. I used to tell people, in your hand, you have the sum of human knowledge, right? Which would differentiate. Like you're poor, you're rich, you have you now have some human knowledge and a PhD, PhD plus intelligence sitting on top of it.
Yeah.
Whether you're, someone in a difficult situation in another country, or you're someone in a less difficult situation in the US, the world is increasingly flat in terms of access to all the tools you need to succeed.
Yeah.
The differences today are whether you have agency and whether you have consistency and whether you're willing to apply yourself. And so I think it's just a great, there's so much we haven't talked about, but it's a great time. No, I mean, there really is. I mean, there's a whole manufacturing renaissance we talk about the whole energy sector, but I really think this is an exciting time if you're someone who is unreasonably optimistic to go and change the world.
But a lot of it is it's just getting started. I mean, it's exactly what you said, because I was speaking to a gentleman in Pakistan, and he has an amazing idea. And he's like, but how do I do this? I don't have the resources. And I was like, you just have to get started, and you're going to piece together the plane as you move forward.
Yeah.
Yeah.
I mean, the dumb thing is, the thing that stops me writing apps I can put in the Apple App Store is just deciding to do it.
Yeah.
Right? All the difficulties that existed before have fallen away.
Yeah.
It is truly amazing what you can do today.
Yeah. Well, I want to thank you for coming on here, because what we're trying to do is just help people learn and understand, what venture capital is all about, and if they're founders, how to, find the funders that are the good match for them. So I really appreciate your time and going deep on some things and giving us hot takes. And it's just been really fun chatting with you.
Well, thank you very much. Thanks for having me on. I
bet.
appreciate it. This has been a lot of fun.